Howdy hoo! Hey, it's Matty Loans, the Mortgage Ponduro. Hope you had a great Christmas because I know I did. Today, we're going wombat hunting. They say that the mortgage business is feast and famine, and that's so true because it's a business that's so predictable. You can count on it, and right now, you can count on it to be cyclical. And if you remember not too far ago during the scandemic when it took some lenders 180 days to complete a refinance, well, those days are gone for now, but they'll be back, trust me. Now we got a new problem, not enough loans. So what do lenders do when they don't have enough credit out in the system? They use gimmicks to try to put a different spin on the same old, same old. So today, we're on a wombat hunt of trends you need to avoid and avoid fast. Now, usually the market will dispose of these trends, but sometimes they need a little pushing, and that's what we're here to do. Take them out. Mortgage country, let's ride. Now, you know the landscape is changing when we saw that cash buyer program go away. And basically, this is a way to catfish a seller into thinking you got an all cash offer. But really, what you're doing is using an investor for funding insurance. So, what you would do is you'd contact one of these companies that would back up your purchase with their funds if you can't get a real mortgage by closing. It was a heads I win, tails you lose prop because you had to pay either way and a significant amount. You know, at the minimum, it was like 1.25% of the sales price just to contract them with the offer. And if you can't close in time, they become your buyer, and essentially you have to rebuy the home from them in the months following. Now, if you had to actually fund the deal, it was actually 3% of the price, which then you had to incorporate into the financing and to take them out. So you go from a buyer to a renter back to an owner. And if this solution may work if it was the only way for you to get an offer, and maybe a year or two ago that was pretty difficult, but this trend needs to go away because of the market. It's no longer a seller's market. Two, it's too costly, and this rate environment, especially this credit market, makes it a different story. Now, if rates are on the decline and things are getting better, well, maybe we'll see this program come back into play maybe in the future years, but right now it's got to go. Now, the market has really put this one in the rear view because one of the major ones was recently sold or acquired. So it's fading fast, and I like to think of it as the pet rock of the mortgage business. Remember that one? The next one's got to be my favorite one, the 2-1 buy down. Yeah, this is something we've actually seen before in the mid-2000s as rates began to increase. Back then, there was a huge refinance boom from 2002 to 2005. And as rates began to sail away, the bank needed a new bag. And just this past Super Bowl, if you remember watching those advertisements for the inflation buster, yeah, that's what this program is all about. And this trend needs to go away because nobody keeps their loan long enough. And when I got into the business, it usually lasted, 6 or 7 years per loan. Now the length of the loan is 3, maybe 4 years max. So it's a huge cost that someone has to pay. Either the lender's got to pay it, the buyer's got to pay it, the seller's got to pay it, somebody's got to pay it. But I'm telling you, it's not worth it. Run the numbers yourself if you don't believe me. I see little value in paying fee for rate. I'd rather see you dispose of it in terms of the down payment or a lower acquisition cost. And I'm just not a fan of paying any points because of the economics of it. It's important to do a break-even analysis if you're ever going to pay points. And sometimes there's an exception, but you're going to have to run those monthly savings divided by the cost of the buy down. And I think we're seeing some people right now that are refinancing loans they just took out 3 and 4 months ago. So what does that tell you? 2-1 buy downs, it's the sea monkeys of the mortgage business. And with that, see you later. The 40-year loan, again, another tool we saw come out last time home prices went through the roof. And this is only available as a non-qualified mortgage program, and you still can get one. It's just not a good choice because the improvement in payment, usually when you're talking about the differential in terms and creating the cheapest and lowest monthly payment, it's just not worth your soul because that's what you end up paying. So this trend needs to go simply because this monthly payment reduction, it's peanuts compared to the 50% extra in interest you're going to pay on a higher loan balance. And I did some of these numbers here with a $200,000 balance and a measly old 3.575 rate. And to boot, you're going to pay a higher rate for the amortization schedule. But if you just look at the numbers, it's just poor. Huge cost for the benefit of a slightly lower payment. And this is like the 96-month car loan. And this just doesn't make good financial sense. Check it. Now, here's one that you should have seen coming from a mile away. Hiring a servicer to make biweekly payments on your mortgage. Don't get me wrong, I'm a fan of you paying extra, but you can do this on your own. And if you think about it, paying someone to do something you can do on your own for free, that is the definition of a wombat. Because when you think about it, biweekly payments, 26 per year over a 12-month calendar year, essentially just making a 13th mortgage payment during the year, which you can do by just divide that extra payment into 1/12 and add it to the principal, or just double up on 1 month of the year and you'll have the same effect. Yes, I'm behind the principal. You can take a 30-year note and shrink it down to 23 and a half years. But to pay somebody to do it, this needs to go because you're going to get a better ROI on your gym membership. So there you have it, folks. The year's come and it's gone. Out with the old, in with the new. And in just a few days, we all start over from zero. In my next video, we'll take a look at some trends you probably need to pay better attention to. That's all I have. Have a happy new year.